Hello, welcome to IG's Week Ahead. With us very shortly will be Tasty Live's Tom Sosnoff to tell us about what's going to move the markets in the coming week. But first, let's get you through all the key details on the economic schedule. First up, we've got Australia out with business confidence, but the key number will be, of course, that consumer confidence and inflation number. This is the expectations of the US. Look out for producer price index out of Japan, and the unemployment rate out of the United Kingdom after data showed that the UK has now risen out of a shallow recession. Germany's out with its ZEW economic sentiment print, and from the US, more inflation data in the form of producer price index numbers, and of course the API crude oil inventories too. Midweek, we've got China's PBOC one-year medium-term loan numbers from there. The Eurozone industrial production will be a bit more key for those of you that trade the euro, because we are now looking out for the ECB to indicate when it will make its first rate cut. And CPI numbers from the US will be a big one for those that trade dollar crosses. The manufacturing index, retail sales, housing market, and EIA crude inventories also will give us a view of how the US economy will fare in the coming months. Australia's unemployment rate will feature early on Thursday, and then later on in the session, look out for building data from the US, manufacturing numbers, and initial jobless claims, as well as industrial output. And last but not least, on Friday, it's that GDP growth rate number out of Japan that will be key, along with China's most recent data plots for retail and industrial production, and the Baker Hughes oil rig count as well. Now let's cross over to Chicago, where Tom Sosnoff is waiting for us. Tom, thanks so much for joining us here at IG. It's been such a key week in terms of not just Fed expectations, but also earnings. But it does look like markets seem to be getting ahead of themselves again. Is it too much a rise too soon?
That's a really good question. And I would argue that a 300 from the bottom to where we are now, it's almost a 300 handle move in the S&Ps. That's the S&P futures, or the S&Ps are SPX, whatever you want to call it. Every index is virtually the same in the S&P world. This has been a very strong 2 weeks where we've kind of bounced off the bottom and we haven't really had a downtick. And 300 handles is just under 6% move. I do think we're probably getting a little too full of ourselves and a little too complacent here. And, there's been virtually no selling. Now, it's been light volume. There hasn't been a lot of intraday volatility. There's been very light volume the last 2 weeks, I would say about 40 or 50% lower than it's been in the prior couple of weeks. So, I think that on paper, if you're asking, is the market ahead of itself, I would argue, sure, gravity eventually takes over a little bit. I'm not somebody that believes in mean reversion in price, but I am somebody that expects some kind of cyclicality.
And cyclicality is what we'll be looking out for in the coming week. What do you think might give the market direction? I mean, we've seen earnings now out of the way. The whole kind of Fed enthusiasm around, will they, won't they, when will they, has also sort of eased. Are we going to see perhaps some sort of propulsion from perhaps the commodities space, where we're seeing some indications of this heating up? Chicago wheat hitting 9-month highs, oil's coming back up again, gold's going a bit crazy, wheat rallying to 9-month highs, as I mentioned earlier, all these weather type events coming through right now. Is that where the action is?
I wouldn't say on the retail side that's where the action is, but it's definitely where the price action is. That means, self-directed traders don't trade, that much soybeans, wheat, and corn, and they don't trade that much silver and gold. I mean, they are actively trading, but on a relative basis, it's a fraction of like what trades in Nvidia and Microsoft and Meta and stocks like that. The difference is that for everybody seems to be so concerned about earnings and interest rates and inflation. I do think that silver kind of exploding the last couple of days, gold exploding the last couple of days, copper exploding the last couple of days. And like you mentioned, a lot of the agriculturals, we call them the softs, those exploded the last couple of days. I do think that's very interesting, especially in light of the fact that people are, they like to freak out a little about inflation. So I don't think I don't think any of those moves are necessarily like they're defensive at all. I kind of feel like they're offensive. So for that reason, I think people are just shifting money. It's like it's risk back on because they're looking for either alpha, they're looking for something with higher volatility. So yeah, I mean, without earnings, you're going to need something to propel this market. So it's either going to be bonds going higher or some of these commodities maybe kind of taking off.
And of course, just one last question. These higher commodity prices might feed into the higher inflation concerns, right? Which might
Yeah,
make the
but
Fed perhaps push back on that timing of the first Fed rate cut.
well, the first Fed rate cut's all going to depend on bonds, on the long bonds. So everybody follows either the 30-year or the 10-year, and they're both kind of what I would call mid-range. The 30 years currently, trading around 116 and a half, closer to 117. And at that level, you're probably looking at a couple of rate cuts later this year. If it drops back down where it was maybe 2 or 3 weeks ago, down to the 113 level, then I don't think you're going to see any rate cuts this year. And if it jumps up towards 120, which is only 3 handles away, and there's a 5-handle expected move for every 45-day cycle, then I think you're looking at maybe 4 rate cuts. So it really depends on what the bonds do. I don't think the Fed will do something independent of what the market's telling them to do.
Thanks very much, Tom. Always a pleasure to have you on. Tom Sosnoff there from Tasty Live. And Tom will be with us very soon. For those of you who are big fans, he will be visiting London with a bunch of the Tasty Live people. So be sure to tune in for more information in the coming weeks when we publicize when you can go and see him here in London. Just taking a look at the corporate calendar, because we have a huge number of big names still to report. Some of them actually from both sides of the Atlantic. Vodafone, full-year earnings. Greg's, Flutter Entertainment also out with earnings. Bayer and Home Depot will be key when it comes to consumption. Burberry out with full-year numbers. Many of our clients at IG like trading luxury stocks, so that will be interesting. Imperial Brands, TUI, ThyssenKrupp, Allianz, Commerzbank, and Cisco as well will make up the earnings calendar on Wednesday. And on Thursday, EasyJet, Siemens, BT Group, Sage Group, Deutsche Telekom, and of course, the big one out of the US will be Walmart out with numbers ahead of target. And that's your key points to look out for in the earnings and also the economic calendar in the coming week. This is IG.